Hello and welcome to this podcast from the Private Wealth team at Safri. My name is Leonora Stevens. I'm a partner of the Private Wealth team based in Bristol. Delighted to be joined today virtually by Mike Hodges, a fellow Private Wealth partner at Safri's, who's based in our Manchester office. Hello, Mike.
Hi, Leo.
Today we are talking about the blockbuster of a budget that was announced by Rachel Reeves on the 30th of October. We decided that instead of recording a podcast on the day or immediately after the budget, we'd leave it a few days to allow the dust and shock to settle, so that hopefully we can provide our listeners with some useful thoughts on the main themes and actions that can be taken, if any, from a private wealth perspective. If you haven't seen our budget webinar hosted by Adam Kay, I would highly recommend watching the recording to cover off the technical areas in greater detail. As on this podcast, we will aim to discuss some of the practical implications. And I would also add there's a great deal of written content on our website, which covers each area in a huge amount of detail. So as a short recap, as many of you will have seen, Rachel Reeves announced changes to both personal tax, business tax, corporate tax, and some tax admin. Today, we will focus our time on inheritance tax changes, mainly around the restrictions to business property relief and agricultural property relief, along with the changes in capital gains tax, including the implications of the changes in business asset disposal relief. We won't cover the non-dom changes in this podcast, as we could easily have a whole podcast on this topic alone. So let's firstly look at IHT, BPR and APR. First question, what actually are these reliefs? Both of these reliefs, business property relief and agricultural property relief, they reduce the value of business or agricultural property when you work out how much inheritance tax has to be paid, either on death or when transferring the said property onto trust, at a rate of 100% or 50%. Currently, there's no cap on the amount of relief that can be claimed, so a landowner can pass down a large estate to the next generation, enabling the farm or business to be maintained without a crippling IHT bill, should they qualify for 100% relief. So the changes announced state that from the 6th of April 2026, 100% APR and BPR will be limited to a combined £1 million. Beyond that, relief is given at 50%. It does also apply to trust relevant property charges, so the 10-year charge and exit charges. Mike, what do you think this change means for business owners or farming clients?
It's enormous, isn't it? You've said we've left ourselves a week for the dust to settle. I don't think the dust has even reached sort of maximum altitude. It's still going up, let alone on its way down towards settling. Because I think there is just so much for people to get their heads around. Partly, I suppose, that's because previously it was quite easy, wasn't it? If you got business or agricultural assets, they were so tax friendly. You could say, die with them in your estate, give them away, put them into trust. It was so benign, perhaps it was too easy and we got lulled. And I think that the brakes have been slammed on and people are really going to have to think, what now do I do? Because you take an asset with a value qualifying for 100% APR, BPR with, £5 million, let's say, above the various nil rate bands. At £5 million, you say, right, there's a million that's BPR, there's 4 million taxable at 20%. That's £800,000 of tax, 800,000, but so we've gone from 0 to 800,000. The comments from some of the Treasury ministers have been around, well, you can pay that over 10 years, but that's still £80,000 a year. And we know that certainly farming is not profitable to that extent that you suddenly say, find another £80,000. It's quite a glib thing to say. I did find myself saying on budget day, it'll be interesting to see what Jeremy Clarkson said, and those of you who haven't seen what he said in the Sunday Times, it's quite interesting. I would recommend you go and have a quick read. He starts off his piece by saying, I rarely write anything angry, but I'm making an exception here, but I'm not going to go down the political path. I think there's a huge amount for people to start to think about, because it is massively, I was going to say life-changing, but I think it is, because if people have had in their thoughts what the plan was for generational issues around agricultural property and business property, they're now going to have to rethink, and it is going to take, because it's in people's psyche and hasn't been. I think people are going to have to think a lot. So it's around, do you sell surplus assets? How do you raise the cash to pay the tax is ultimately what it's going to boil down to.
I think also when you're looking at that, they tend to be asset rich and cash poor. If on death they're going to have to sell a few acres of land, are the neighbouring farmers going to know that that's a fire sale? They need to sell it quickly to liquidate to pay for the tax. Is it going to depress agricultural values?
But giving away Jeremy Clarkson's punchline, he says, actually, don't worry about it, because probably the value of agricultural land, just as you said, will fall to the extent that it's really not a problem, because your £1 million plus the various other allowances will cover you. That's his facetious conclusion to the whole thing. But in all seriousness, I think people are going to have to pause for breath even longer than the week we've given ourselves and redraw a lot of their plans. And if you take the average age of farmers, someone said to me that it's early 60s, and that's a real difficult situation, because you would have been planning on one basis, and now if you're looking to pass the business down through the generations, then stop, rethink. We'll be talking to clients about this, I suspect, all the way up until the change actually comes in.
But I think when you look at the average age of the farmer, farmers are carrying on farming for longer.
Yep.
The problem is the next generation don't necessarily want to take over yet, because from a financial perspective, it's not necessarily viable for them to pay for their children to go to school, or so from that perspective, they're all getting other careers to then come back to farming. And another thing that I find slightly baffling is that when we came out of COVID, everyone was really interested in how we were trying to make sure that we were self-sufficient for food purposes, and we want to try and grow as much as we can here. Yet I look at farmers' profits over the last couple of years. This year's been a bad harvest. Last year was bad. The year before was a good one, but they're not making huge amounts of money as it is, and let alone we're now going to have this potential IHT charge. And a lot of them have potentially paid some professional fees for planning before the budget, and now it's all going to change. And you think, well, sort of trying to keep the politics out of it, it disincentivizes people potentially, because where's the benefit?
It's
not like they're all raking in lots from profits from their farming activities. That they're not.
No. The sad thing for me is, because it gives us more work, we could say fantastic, because it'll keep us in work for the next 18 months or so until this change comes, along with all the other changes. But that's not good news for the business community. That's not making the UK economy more productive. Well, I suppose in some ways it is, but not that I would say in a positive way. But I'm going to get more political now, so better draw a veil over this one.
Okay. Have you got any thoughts on what people can do from an IHT planning perspective going forward in light of changes?
Yeah, in a technical sense, it was quite odd, because the changes were relatively small, and there wasn't change across the whole piece. So the 7-year accumulation period for inheritance tax didn't change, and that's the rule that says when you die, it's your death estate plus gifts made in the previous 7 years, as people I'm sure will know. So it's going to throw the focus much more on lifetime gifts, I think, as long as that makes sense in the round. Great on the tax side, because someone pre-budget, when we were in that sort of mad time of what you could do, someone said, well, I've got £1 million of assets, should I give them to my children? And I said, well, you're giving them to your children, so you've lost control of that asset. So that's not a tax question, or there are umpteen questions before you get to the tax question. So I think that's where we're going to be sitting down with clients and saying, right, let's restart what we do, how we look at this. So lifetime gifts, trying to survive the 7 years, might be the order of the day. I suppose what you then don't get, although if it's an asset passing through the generations, not so much of an issue, is the increase in market value at the date of death, because by definition you're saying, right, make lifetime gifts. The question will be, I suppose, is it lifetime gifts to individuals, the next generation or generations, or into trust? That'll be a discussion point for particular families and what their situations are. So all sorts of different thoughts to have. We focus a lot on farming and agriculture, exactly the same proposition for the owners of family companies, family businesses. I was talking to you as we were chatting before this about a business in what started off in the Northwest where I am, that's a 7th generation business. Now, there'll have to be some serious thinking about, well, what does Generation 8 look like? And what's the best way to get the business into Generation 8 and beyond? Because this is a real roadblock, I would say. And I suppose the final thought on lifetime gifts is around insurance. So I think you were going to have some thoughts on that.
I think there'll be a definite resurgence of insurance to cover the potential IHT on failed gifts. So I think that is an area that people, if they are trying to give away more things now, to consider getting some cover for the potential IHT should they not survive the gift. One other thing though about lifetime gifting is to be careful not to fall foul of the gift with reservation of benefit. So if people are younger and giving assets away, but actually they need that income, or they do still need to benefit from that asset, they need to be careful of the traps on that they then don't fall foul that the assets are then still within their estate for inheritance tax purposes. So that is something that people should keep in mind. But Mike, have you got there? I think when we discussed this earlier, you had a couple of other points that people could think about for planning.
I think for the family business, and again, one of the things that didn't change in the budget, and we might have thought it could have done, is the family investment company concept, which I think was that our very first podcast, certainly a very early one. I think still the most popular. So if you haven't listened to that one, do. So that concept is still there, and that conceptually has people thinking about different rights in shares for different generations. So, and what I mean by that is, so you don't just have to have a company with one class of share and every share is exactly equal. So you can have shares which have capital rights. That's where the value sits. Shares that capture the current value of a business, whether it's trading business, farming business, whatever, that you might say, well, if we lock in today's value with the older generation and issue shares to the younger generation that take any future increase in value, then that's a way of freezing value. So they're called freezer or growth shares. So you might look at those sorts of things, and then you've done something towards the planning, and then one generation isn't seeing an increasing value that is going to be subject to these increased inheritance tax rates. But that's going to be very, very family specific, and that's great for us, Leo, because lots of work for us, but not necessarily what clients were looking for. They're looking for a more fruitful use of their money, good value as we are. And I suppose we're also going to look at flip side. There may be assets that are in trust already or in some sort of structure. So questions will come around, well, do we want to think about whether that is the right long-term holding structure for those assets? So that's why I said, not semi-facetiously at the start, that I don't think the dust has even reached maximum altitude yet. It is still sort of spreading, and it's going to come down, and people are going to have further thoughts, and it's going to be very bespoke for situations. So tricky times, or interesting times for us.
It is, especially if, as I say, we've done so much work in anticipation of what these changes were going to be. A thing that a lot of clients should be doing now is looking at their wills and reviewing how the flow of assets is due to go. If this 1 million allowance is not transferable, then I think people need to look at banking the 1 million for each spouse member. So obviously, automatically, if you were going to transfer all your assets to your surviving spouse, well, then you will have lost that £1 million of relief. So thought needs to be given to that to make sure that, say, you're claiming as much as you can. I think the key thing that we've discussed amongst all of our colleagues is that, as you said, let's not rush. Let's wait for a bit. There should be some technical consultations being released in early 2025. So I think at that point, we then need to have a more detailed look at what planning we can do and mitigation, if that's what people need to do.
Yes, and I don't know whether the door is slammed shut on any modifications to this or not. There certainly feels to be a bit of pressure building, but we'll have to see. And that's why I think you're right. If people were to say, right, I want to do something in the coming weeks, I would counsel just pause, don't rush into anything. Even if nothing changes, give yourself some time, live with it for a bit, because I think that's what we're having to do, is get our heads around a whole new way of operating and thinking.
So. Well, it's a bit like the pre-budget planning. Our motto was very much, if you were going to do something anyway, do it. but don't
Absolutely.
necessarily
Yes.
create a tax bill, create
Yeah.
a trust for the sake of it if you weren't going
Yeah.
to.
Yeah.
Just wait and see. But then there's obviously also there's the pension changes in that now that your pension pot won't go free of inheritance tax. But if you're leaving it to your spouse anyway, then it's still free of inheritance tax. But I think a lot of people are considering now whether they should start taking that 25% tax-free lump sum to spend and start
Yeah.
reducing that exposure on that front.
That's flipped around 100%, doesn't it? Or 180 degrees, because people are now saying, right, old world planning, that would be the last resort. I'll spend everything else and then I'll come to my pension because that's inheritance tax free. Now it's probably flip it around the other way.
Well, as I say, we could talk about inheritance tax and put it, but it's just I say it's frustrating, not frustrating, but I'm very lucky. I love my job, and these things add complications. But the amount of thought that's gone into pre-budget, sort of the anticipation, this has been a slight curveball. So more interesting things to come down the line, I think, from that one. But then if we move on to capital gains tax, which wasn't quite as eventful as we thought, and thankfully the rate wasn't as high as we expected. And so the Chancellor announced that the rates of CGT, which were 10% and 20%, are going up to 18 and 24. And so that 24% is in line with the rate of tax on any gains on the sale of residential property. So that took effect from the 30th of October. We actually had a sweepstake at work. In amongst the busyness of the pre-budget planning was what the rate would go up to and would it be imposed from the 30th of October or from the 6th of April. So Mike, what are your initial thoughts on this change in the rate of CGT?
Well, on that sweepstake, I'd have been completely wrong because I was going for 30% and I was going for a change in the main rate from 6th of April next year because I thought Rachel Reeves would want to have a bumper 6 months of collecting tax revenues as people rush to do transactions. So I was wrong about that. I think, leaping to my conclusion, not as bad as it could have been. I think a lot of people thought worse. A lot of people had liquidated assets, as you say. I've got one client who was adamant we were going to have the same marginal rates of income tax and capital gains tax. Interesting, but I suspect behind the scenes they listened to private equity, and we're not going to talk about carried interest because again, that's not really the scope of this. But my worry pre-budget was, were they going to stop transactions happening because they'd equalize rates of income tax and capital gains tax, and people would stop selling assets. They haven't done that, so they'll keep the thing ticking over and people paying their capital gains tax. So it's again very, very interesting to see what happens. And you were going to say something about business asset disposal relief.
That's where you could, if you sold your business, you would pay 10% on the first £1 million of gain, with the balance being at 20%. So from 6th of April 25, this will go up to 14%, moving up to 18% from 2026. So this does appear to be phasing out an essential relief which incentivises the UK wealth creators. But without trying to be political, it does seem to contradict slightly the government's ambition for the UK to be a global hub for startups, particularly in tech and AI, where we're not really offering any incentives for these people to set up their businesses, because once they sell them, the rate of capital gains tax is not as favourable as it was. Although, saying all of that, I still think the Treasury are going to have a bumper year this year with tax collections, mainly pre-budget, actually, with everyone liquidating. But the change in BADR, I do wonder whether, we've not gone around the houses slightly on that over the last few years, but we had £10 million of gains initially, and then there was a funny calculation when it was first brought in. I think it was at 4/9 of the gain was taxed, etc.
Yep.
So it's moved around, but hopefully that's something that might be reviewed in due course if we do see a change in those startups, and think people moving overseas and looking at starting elsewhere instead of creating businesses in the UK providing employment. Moving up to the 18% will be moving up to the basic rate, which makes sense. But let's see what happens in due course.
Yeah, the more you say that we've been going for 20 minutes because our producer Erica has said, "Hang on, your time's up." But I could keep going for another 20 minutes because there's so much other stuff that we haven't touched on here, isn't there? You think, wow. And business asset disposal relief, I think Adam said in his presentation the morning after, is going to be worth £60,000. So in the scheme of things, it almost becomes not worth worrying about. There've been times, as you said, where it was worth huge amounts of money. So you did a lot of planning to make sure people qualified.
And also the criteria to get it is also,
Yeah,
quite not onerous, but you have to do a detailed review to make sure that you will qualify for it. But
yeah,
actually, for £60,000, is it worth it? So,
Mm.
and have you got any other sort of, as I say, we can't cover everything in detail. Any other parting comments on the budget before we wrap it up?
I do like a funny story, or funny in the world of tax, and we were sitting there in the immediate aftermath of the budget, and some clever, way smarter than me, said, "Hang on, if this is more on the sort of IHT side, and the rules we haven't talked about, it's going to move from a domicile basis to a residence basis, whether you are within the IHT net, and you will have to be resident for 10 out of 20 years." And curveball came in from one of our Peterborough partners saying, James Stevens, I'll give him a name check, saying, this is a huge planning opportunity for anyone under the age of 10 who will therefore be outside the IHT net because they can't have satisfied the 10 out of 20 years residence requirement. So we sat there for about 3 minutes mulling over whether there was any planning opportunity involving 8, 9, 10-year-olds, and concluded, well, going back to my point earlier, no, you're not going to give all of your assets. Even if you could, you wouldn't. But that bit of sort of light relief in the midst of it all. And I suppose finally, we've been fairly doom and gloom, haven't we, in this? We're still both smiling, and some significant changes. The capital gains could have been a whole lot worse. And I suppose my worry is this the first instalment, and have we got more to come? But we'll have to wait and see on that. And all we can ever do is plan with what we've got.
Well, yeah. Well, indeed. Wait and see. Well, thank you,
You are
Mike.
you are still smiling, yeah?
Yeah. Thank you very much for joining me today. We work with a wide range of clients. Many are UK based and many live overseas but have interests here, whether that's property, business interests, or investments. We advise individuals and families on how best to safeguard, maintain, and enhance their wealth, and on the most appropriate methods of passing on that wealth to the next generation. We also help people comply with the tax rules in the UK, which can be complex. If you'd like to find out more about the services we can offer at Safri, or any more information on the budget, please visit our website at www.safri.com. However, it's important for me to stress that if you're considering any of the topics discussed today, you must always take professional advice based on your individual circumstances. Thank you for listening.